Everyone thinks real estate investing is complicated. It is not. Throughout history, we have evidence of many different families and wealth builders across many different empires who played the real estate game to perfection and built massive amounts of generational wealth. Rather than focus on specific tactics and strategies, I want to go through three simple rules that I think you can find across history, across many of these families. And we're going to talk about the Roman Empire specifically, that helped families to build empires, survive economic collapses, and create generational wealth that lasted centuries. I'm going to show you exactly what these rules were, how they actually worked in practice, and why they're even more powerful today than they were in ancient Rome. Because here's the thing, we have better tools now. We have better education. We have a little more equality in terms of access to opportunity. I don't want to delve into it too much, but it's a little bit better. We have 1031 exchanges, step-up basis. We have 30-year fixed mortgages. The Romans had none of that. But part of the premise of this entire channel and brand is that there are principles that echo through eternity and that we can continue to find and access in our own journey. That fundamental code has not changed. So let's dive in. The pharaohs of ancient Egypt didn't try to own every square mile of desert. That would have been insane. Instead, they controlled a narrow strip of black silt across the Nile River, maybe a quarter mile wide. But that quarter mile fed millions of people, employed entire labor forces, and controlled the economy of the most powerful civilization on earth. They owned the choke point. Fast forward to Rome. The patricians, the old money families, they understood this same philosophy. They did not buy random parcels. They bought the roads leading into Rome, the port facilities, the aqueduct access points. They bought the assets nobody else could easily replicate. Here's how I see this translating today. In a downtown grid, it might be the corner lot with triple frontage. In a beach town, it might be direct beach access because they're not making more coastline, guys. It's just not happening. In a growing city, it might be the last available bridge with unobstructed views. Or conversely, it might be the primo location within the city on the top retail block, like the place you have to be. Location, location, location. We all understand it. It's always been a rule. It is a truism for a reason because they are like choke points. These are not just properties. You're buying strategic position. I see people in this business chase spec plays all the time. They hear about some hot market, they rush in, they buy whatever the hell they can get a hold of, and then they wonder why the returns are fairly mediocre. And it's a core principle for my investment firm. Scarcity beats speculation every single time. When you own something that literally cannot be replicated, whether it's because of geography, zoning, or pure physical limitation, you have built a moat around your own investment. That is really valuable, and especially so in real estate. So the question you need to ask yourself on every deal you're looking at, whether you're looking at as a passive investor or you're trying to buy your own fourplex or eightplex or whatever plex it may be, can someone build this exact thing next door to me? Or to say it differently, is this thing easily replicable and buildable? If the answer is yes, you might want to keep looking. And if no, you might have found something worth owning. Bunch of caveats with that, right? What's the price? What's the quality of the asset? What's the debt look like? But all else being equal, this is a really important question. How easy is it to build competition for yourself? Rule number 2, controversial, but I'm going to say it anyways. Align with the state. Let's talk about Rome again, where the patricians, the old money elite, perfected something that we can learn something about today. They turned vast tracts of public land called Ager Publicus into sprawling mega farms called the latifundia. This land was supposed to belong to all Roman citizens. Instead, the senators simply occupied it, farmed it, and treated it as their own private property. By today's standards, this was corruption, plain and simple. And I'm not saying this sort of thing doesn't happen today, because it does, but it was more institutionalized then. These senators were not just getting favorable terms. They were exploiting their political connections to access resources that ordinary Romans couldn't touch. And at some point, we're going to do an episode on my favorite guys, the Gracchi Bros, and we're going to talk a little bit more about why this really was a problem for Rome. But here's the principle behind this that we simply cannot ignore. When your investment strategy aligns with what the state is incentivizing you to do legally and ethically, that is not corruption, that is smart positioning. Today, we have the tools that the state has given us, and they absolutely favor certain behaviors. The 1031 exchange rewards long term holding. Opportunity zones incentivize investment in distressed area. Appreciation schedules favor real estate over asset classes. These are not tax loopholes, they are policy decisions. The government wants people investing in real estate, they want people holding properties long term, and they want people to improve communities. So they built the tax code to reward it. The Roman patricians corrupted the system. We don't need to do that. We just need to understand that our system is designed to reward and position yourself accordingly. When cheap debt is available, lock it in. Ideally, long-term fixed rate financing. I've personally sworn off of bridge debt. I'll talk about that more at another date. When tax incentives favor long-term holds, hold long-term. When the state wants capital flowing to certain markets or product types, pay attention. Just pay attention to it. Somebody commented to me the other day, real estate people don't add any value to society, blah, blah, blah. My retort is, who the hell is going to renovate all the housing stock? I mean, most of the housing stock in this country is old, right? The plumbing is old, the electricity is old. Somebody's got to fix it. Somebody's got to improve it. The state's not doing it. Nonprofits aren't doing it. Who is going to do it? The government wants you to invest in real estate. So, you should do it if that's your asset class of choice. We are not gaming the system. We're just reading the map the government published. The difference between Rome and today, we have rules, more equal access for your average man or woman today in this society. We just need to follow the rules intelligently. Rule number 3, never sell the core. This is where we separate traders, in my opinion, from dynasty builders. Old money families don't flip buildings, they keep them. The Duke of Westminster's Grosvenor estate bought 300 acres in London in 1677. Those acres, now Mayfair and Belgravia, still fund family trust today, over 340 years later. That is strategy across centuries, guys. And here's what they understood. True wealth isn't about maximizing one transaction. It's about building an eternal, perpetual income machine. Most investors I run into in real estate think like this: buy low, sell high, take profits, move on. But that is trading. And trading has its place. But if you want to build long-term generational wealth for you and your family, you need to identify your core assets and put them in the do not sell box. Maybe it's the fourplex that covers your mortgage. Maybe it's the commercial building that generates consistent cash flow. Whatever it is, designate it as foundational. Here's what I do and what I would recommend everyone else to think about doing. We put all of our assets into a trust. On that trust, we've indicated if any future heir wants to sell this property, they must wait 30 days and write a one-page letter explaining why this foundational asset should be liquidated. You'd be shocked how often that impulsive sell decision dies when you have to articulate a compelling reason. Because most of the time, the reasons aren't good enough. I want to buy something newer. Not good enough. The market looks hot. Not good enough. I could use the cash. Definitely not good enough. This isn't about being rigid. It's about being intentional. The goal is to build something that outlasts you and benefits your children and your grandchildren and continues to benefit your estate for a long time. As a former advisor to ultra wealthy families on Wall Street at Goldman, the number of times I saw second and third generation liquidate or sell foundational assets and sort of blow themselves up, or at least set the family on a decline path, is astronomical, guys. It's astronomical. There is a reason this saying exists in many times across many cultures and many places. The first generation builds the wealth. The second generation maintains the wealth. The third generation goes back to rags. It is an observable trend. I've seen it way too many times. Bonus benefit, sort of similar to benefit too. Taxes are for merchants. Even ancient Rome understood that smart structuring beats brute force. The Emperor Augustus imposed a 1% land transfer tax on property sales, but he exempted estates passed to direct heirs. He wanted wealth to stay within families, compounding across generations. 2,000 years later, the US gives us the same tools with different names: the 1031 exchange and the step up in basis. The 1031 exchange lets you defer capital gains indefinitely by rolling proceeds into new investment property. You trade the duplex into an eightplex, then into a 20-unit building, deferring gains each time. Your wealth compounds untaxed. The step up in basis is even better and frankly crazier. When you die, your heirs inherit assets at the current market value. All the gains that you accumulated during your lifetime wiped clean. They get a fresh cost basis. Your kids inherit the empire. Now, this conversation gets more complicated if we bring in estate taxes. Not the premise of this call, this or video. The step up in basis is what matters. This is, again, not a loophole. It is how the tax code is designed. They are incentives designed to reward long-term holding and strategic reinvestment. Think about the 1031 exchange for a second. Or you've had your money in a building for a long time, right? You've made a bunch of money. You want to roll it somewhere else. Why would the government want you to do that? The answer, harken back to rule number 2, is they want you to move capital through the system to improve assets. Money that's locked into this is sort of contrary to rule 3, never sell a crown jewel. But the government wants to incentivize taxpayers to move money, have a free flow of capital through the system so the housing stock gets rejuvenated, so buildings can improve, because guess what? They don't want to do it. So to not do it, they create a tax benefit for you to do it. Again, align yourself with what the government, what Uncle Sam is asking you to do, align yourself with it. Why wouldn't you? That's the society we live in. So here's an actual playbook for someone with normal capital in today's market. First, zoom out. Stop looking at individual houses. Look for the irreplaceable asset, the thing that adds a ton of value, right? The lakefront parcel with limited access, the corner lot on a zoning boundary. Find the choke point, then underwrite it conservatively. Second, when rates are favorable, lock them. Don't wait for perfect. Lock fixed rate debt, then let inflation do its work while your rents march higher. Your payment stays frozen. Theoretically, your income grows over time. Third component here, in the system we live in, which is a fiat debasement system, taking fixed rate debt is a very smart move. I'm not saying take big debt, right? Maybe it's 50% leverage. The value of the debt dies over time because the dollar is being devalued over time. So your asset improves with inflation, the rents improve with inflation, and your fixed rate debt that you used to buy it is withering away thanks to inflation. That is a winning formula, guys, like a winning formula. Third, pick one property, just one, the property you'd hand your grandchild. Put it in the do not sell box, figure out how to protect it, write the instruction letter, talk to your children, your grandchildren, anyone about it. I talk to my kids about our real estate all the time. I have 4 children, by the way. Like, nightmare scenario. Like, what happens when we go and there's 4 kids and they got to figure out what to do with this, like all the assets we own. Don't want to do it, right? I'm going to figure out how to protect it, preserve the core so my children are protected long after I'm gone, and hopefully my grandchildren and great grandchildren and whatnot. Protect it. The tools have upgraded, guys. We are no longer working on scrolls. We have Excel. Now we have AI. Who knows what's coming in the next couple of years? This is good stuff, though. Like, we're really improving ourselves, but the fundamental code has not changed. In my humble opinion, it has not changed. Control the source, lever prudently, never slice off the family jewel for a quick profit. Nail those 3 rules, and you are starting to talk about building real generational wealth. You are buying for centuries. Rome survived its Neros, its hyperinflations, its political chaos. The people who held the irreplaceable dirt and held through the noise, they survived in some shape or form, right? Survival we can define by different respects. Obviously, none of the old patrician families are alive today, but does that matter? They mean several hundred years of survival. If this clicked for you, hit me with a comment. Hit that subscribe button. Join us. We're building a community here, a movement around timeless investing principles, understanding the history behind where we are today, understanding the trends and the patterns that have built the world that we live in now and how that influences our investing decisions. Think well, act wisely, build something timeless. Thanks for being here.